Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheikh Sise, your tutor and your mentor. Today, we are going to cover IAS 38 Intangible Assets. We are going to look at the definition of intangible assets, looking at the recognition criteria and how we can amortize the intangible assets. Also, we are going to look at the distinction, the accounting treatment between the research and development cost. We are going to look at how we can amortize the capitalized development cost, which is very much important concept we need to know. And finally, we are going to cover the IFRS 3, which is the business combination. We are going to look at the definition of goodwill, the positive as well as the negative. So when we talk about intangible assets, it is an identifiable non-monetary assets without physical substance. When we are talking about tangible assets, the property, plant and equipment, the motor vehicle, for example, they have a physical substance. But when we are talking about intangible assets, they are assets without a physical substance. So when we are going to look at the further aspects of the identifiability, we are going to look at the condition for us to classify an intangible asset to be identifiable non-monetary asset. So now let's look at examples of intangible assets. For instance, we are talking about license and quotas. Now, if you want to establish a mobile network company, if you want to establish a TV or radio station, if you want to establish a fishing company, you need to secure a license. The license will give you the legal right. The license will give you the operational right. The license will give you the access to operate within that particular industry. So now if we are talking about the mobile network, for you to be able to establish a network or a telecommunication, you need to secure the telecommunication license. For you to establish a TV station or radio station, you need to secure the broadcast license. For you to establish a fishing company, you need to secure the fishing quota. So this is an example of intangible assets, which is the license. Also, we are going to look at the intellectual property, the patent, the copyright. Also, we are going to look at the brand names. For example, we are talking about the Nike, Coca-Cola, Apple, and Toyota. For example, if I'm going to establish audit firm in Sierra Leone, which is a local audit firm, but I want to use the name of an international audit firm. For example, we are talking about KPMG. If I want to use the KPMG in Sierra Leone, I can say KPMG Sierra Leone, but I need to ensure that I acquired that brand name from KPMG. So that will give me the right to use the KPMG name in Sierra Leone. I'm going to operate independently, but I'm going to use the brand name. So when I'm going to prepare my financial statement, the amount I'm going to pay to use the brand name KPMG Sierra Leone, I'm going to recognize it. I'm going to show it as an intangible asset in the financial statement. So another example of intangible assets is the trademark. And we have lots of examples. We have the Nike, the Apple logo, the McDonald's, so on and so forth. So now we need to note one very important point. As I mentioned from the introduction, we need to understand what is identifiability according to IAS 38. When you look at the definition of intangible assets, it's an identifiable non-monetary asset. So we need to understand what is the exact meaning of identifiable. Now, it has two meanings. First, it is separable. It means when we are talking about the brand name, we need to sell the brand name without selling the whole business. As I mentioned earlier about KPMG, KPMG will sell the brand name to me in Sierra Leone, but they are not going to sell the whole of the business to me. So the brand name you are going to sell should be separable from the rest of the business. So this is what we refer to as the identifiable non-monetary asset. It should be sold separately without selling the rest of the business. Another criteria, we are going to look at it furthermore when we are going to look at the consolidated financial statements, when we are going to look at the goodwill and how we can account for the goodwill. So now, we are going to look at the definition of an asset. Whenever we are talking about the recognition of an asset, we need to understand the conceptual framework. What is the definition of an asset? We are going to look at the three aspects. We are going to look at the controllability. We are going to look at the past events. And finally, we are going to look at the future economic benefits. So these three conditions should be met whenever we are talking about the definition of an asset. So now, we are going to look at the recognition criteria as per the conceptual framework, which is very much important. So when we're talking about the recognition criteria, the first among the recognition criteria is the definition of intangible assets. We need to ensure that the definition of an intangible asset is met before we are going to consider whether or not we are going to recognize this as intangible assets. The identifiability as well as without the physical substance, we need to know them. Secondly, under the recognition, we need to know the recognition criteria, which is the probability of the future economic benefits as well as the cost of the assets can be measured reliably. Now, when we are going to look at the reason why we are not going to recognize internally generated intangible assets, it is because of the cost of the assets cannot be measured reliably. But when we are going to further aspect, then we can able to understand what I'm trying to say. So now let's talk about the purchase intangible assets. If an intangible asset is purchased separately, such as license, patent, brand name, it should initially be recognized at cost. We are talking about purchased intangible assets. We are not talking about the internally generated intangible asset. This is a purchase internally. This is a purchase intangible asset. So we are going to recognize it at cost. When we are talking about at cost, it means we need to look at the purchase price. We need to look at all other directly related costs to ensure that the intangible assets fit for its intended reason and purpose. So also we are going to look at the subsequent measurement, the subsequent recognition. We have the choice, we have the option to use either the cost model or the evaluation model. So let's talk about the cost model. The intangible asset should be carried at cost less amortization and any impairment loss, which is very much important. And also, we need to note this when it comes to the cost model. This model is more commonly used in practice. In real life, it is mostly used, the cost model. Now, when we are talking about amortization, it's the same concept for depreciation. Amortization, we are using it when we are talking about intangible assets, and depreciation is when we are talking about the tangible assets. So now, this is a very key concept we need to know. We need to know this concept as it is very much important for the examination. An intangible asset with a finite useful life must be amortized over that life, normally using the straight line method with a zero residual value. So for intangible assets with a fixed amount of life with a fixed period, we need to amortize that intangible asset over a useful life. For instance, if we secure a license to operate within the telecommunication for 5 years, it means the cost we are going to incur for that particular intangible asset should be amortized over the 5 years period. On annual basis, we are going to show an expenses of certain amount until the final year based on the agreement. Secondly, an intangible asset with an indefinite useful life should not be amortized. So it means when we are talking about indefinite useful life, we don't have a specific period. For instance, 5, 6, 7 years. No, we don't know the exact period. So what is the accounting statement about short intangible assets? First condition, we are not going to amortize that particular intangible asset. So now if we can remember when I covered IAS 40 investment property, when investment property is carried at fair value, we are not going to depreciate that particular investment property. So we have seen two situations where we can't, depreciate or amortize an asset. So we need to note these exceptions, and also it is very much important for objective test questions. So we are not going to amortize an intangible asset with indefinite useful life. We are not going to amortize it. Secondly, on annual basis, we are going to do impairment test. We are going to look out for indicator of impairment. We are going to look at the possible indicator of impairment. So these are the two things we need to consider when we are talking about intangible assets with an indefinite useful life. So note this point down. Now we are going to look at the evaluation model. Intangible assets may be revalued to a carrying amount or fair value less the subsequent amortization or impairment loss. Now, when we are talking about fair value, we are going to look at IFRS 13, the fair value measurement. We are going to look at it in details. So for now, we just need to know that we are going to use the evaluation model. Under the evaluation model, we are going to use the fair value concept as per IFRS 13. Also, IAS 38 states that active market for intangible assets are real and specifically prohibits the evaluation of patents, brand names, trademarks, and publishing rights. So these four categories of intangible assets should not be revalued. We need to note these points down. For intangible assets, for brand names, for patents, for trademarks, and publishing rights, we are not, it is prohibited by IAS 38 to revalue these four categories of intangible assets. We need to note it down as well. So also when we are going to look at IFRS 13, we are going to look at the definition of an active market. So for now, let's keep it simple. And also we are going to cover IFRS 13, the fair value measurement. Very good. So now we are going to look at the distinction between internally generated intangible assets and purchased intangible assets. So now, for example, currently 2 months ago, I started the MSS mentorship and online classes, and in 5 years' time, inshallah, I will have a global recognition. The global recognition will be achieved based on the number of pass rates for my students, and also and the public image, the good reputation. So I'm going to develop this goodwill, this reputation, this brand over a specific period of time, let's say for 5 years, for example. So now, during the whole period from now till 5 years, it will be very difficult for me to assert, for me to identify, for me to calculate the cost that is related to the goodwill I'm going to develop in the next 5 years. So now this is the concept of internally generated intangible asset. Generally, internally generated intangible assets cannot be capitalized. We are not going to capitalize it. The reason it is because the cost that is associated with the intangible assets cannot be separately, identified from the rest of the business. As I mentioned earlier, currently I'm working on MSS mentorship and online classes. It will be very difficult for me to, allocate or to identify the cost of the good image, the cost of the reputation, the cost of first attempt pass rates from my students, the cost of my mentorship. It will be very difficult for me to identify it from the overall running cost of the business. So because of this reason, when we look at the recognition criteria as well for intangible assets, it's clearly stated according to the conceptual framework that the cost should be measured reliably, which is very much important. So now this is the reason why we are not going to capitalize, why we are not going to include internally generated intangible assets as part of the component of the financial statement. It is because it is not in line with the conceptual framework. We can't measure it reliably. So all internally generated intangible assets, we are not going to capitalize it. We are not going to include it. But now, let's assume someone in next 5 years, individual or company want to use the brand name MSS mentorship and online classes. So now the amount they are going to pay to have access or to have the rights to use the MSS mentorship and online classes, the individual or company will be able to recognize that particular amount as intangible assets in their own financial statement. But for me, I am not going to recognize it as intangible asset because it is internally generated. While for that particular individual or company, it is a purchased intangible asset. So they are going to recognize it as an intangible asset. So this is the distinction, and this is the reason why we are going to, why we are not going to recognize the internally generated intangible assets. So we have an example: goodwill, the inherent goodwill, which is the internally generated goodwill, the brand, the published entitled, customer list, and etc. So now we have an exception for brand. The accounting treatment of brand has been a matter of controversy for some years. IAS 38 intangible assets has now ended the controversy by stating that internally generated brands and similar assets may never be recognized. Expenditure on internally generated brand cannot be distinguished from the cost of developing the business as a whole. So should be written off as incurred. We are not going to capitalize that particular internally generated intangible assets. Where a brand name is separately acquired, as I mentioned earlier, someone decided to use the MSS mentorship and online classes, they are going to recognize the brand name under their own financial statement and can be measured reliably. Then it should be separately recognized as intangible non-current assets and accounted for in accordance with IAS 38, which is very much important for us to know. So now we are going to look at goodwill. For this level, what we need to know for IAS 38, we need to know the definition of goodwill, and we need to know the distinction between purchase goodwill and the non-purchase goodwill. So basically, when we are talking about goodwill, this is the difference, this is the excess, this is the additional amount we are going to pay for the value of a business as compared to the fair value of its separable net assets. Let's keep it simple for now. When we are going to look at the consolidated financial statement, we are going to explain about goodwill, the calculation, the concept in detail. So goodwill may exist because of any combination of number of possible factors: reputation for quality of service, technical expertise, good management and staff. So these are all reason why goodwill may exist. So now let's take a look at purchase and non-purchase goodwill. For purchase goodwill, we are going to recognize it as intangible asset in the financial statement. We are going to recognize it. Simple. That's all what you need to know about purchase goodwill. We are going to recognize it. For non-purchase goodwill, it is also known as inherent goodwill, has no identifiable value. It is not recognized in the financial statement. As I mentioned earlier, non-purchase goodwill is the same as internally generated goodwill. So we are not going to recognize that internally generated goodwill, the non-purchase goodwill. We are not going to recognize it in the financial statement. So also, when we are going to cover consolidation, we are going to look at IFRS 3, the business combination, in separately. So we don't need to worry about it under this chapter for now. We just need to know the definition of goodwill and also how we can account for purchase goodwill and the non-purchase goodwill. Simple. This is all what we need to know for now. So now we are going to look at the research and development cost, a very important area for us to understand, as per IAS 38. So now we need to look at the distinction between research and development cost. So when we are talking about research, it's an original and planned investigation undertaken with the prospect of gaining new scientific knowledge and understanding. So this is research. So now when you're talking about research, it means we are going to expense it. We are not going to capitalize it. Development is the application of the research findings or other knowledge to the plan or design for the production of new or substantially improved materials. So this is the development. So now, what you need to know and understand the distinction between research and development costs and how we can account for research and development costs. For research, we are going to expense it. Simple. Research expenditure write off as incurred to the statement of profit or loss. We forget about it. Now, let's look at the development expenditure, which is very much important for us to recognize a development cost as an intangible asset. These conditions should be met. All of the conditions should be met. So now, one of the conditions we are talking about the probable flow of economic benefit. We are talking about the P. It means the cost, the reason why we are going to incur the cost, we need to see the future economic benefit from the asset, whether it will increase our sales revenue or it will result to a significant cost savings. So I'm going to make an acronym P. And when we are talking about the second condition is the intention to complete the intangible asset. Management should have the intention to complete. When you're talking about intention, the management needs to have several meetings relating to the completion, related to the progress of the development phase of the project. So we need to see the meeting, we need to see the minutes of the meeting, and we need to see memo that will, that will justify that management intend to complete this particular development project. So that is the I. So we are talking about can be measured reliably. Reliable measurement of development cost. It's obviously that the amount we are going to spend, we need to measure it, we need to calculate it. So we are talking about R. Adequate resource to complete the project. It is obviously that we need to have adequate resource. We need to budget for the project. We need to have, the resources available to support and to finance the completion of the project. So the resources should be available, which is the A. Then we are talking about the technical feasibility of completing the intangible assets so that it will be available for use or sale. We need to have the expertise. We need to have the individuals that can, that can able to complete the development phase of the project. So that is the T. And finally, we are talking about the expected to be profitable. It's obviously we need to have the expectation based on the discussion with the technical people. We need to have the expectation that this development will be profitable. It will result to a significant um, increase in sales or a significant cost savings. So these are the conditions we need to know. So this is the abbreviation of PI8. So we need to know them. When we are going to solve questions, we are going to see the relevance and importance of these conditions. Also, for strategic business reporting students, you need to know how to, apply these conditions in real life because, in the examination, you will be asked to explain the accounting treatment for development costs. So for you to be in a better position to explain the treatment, you need to know this condition because your explanation, your analysis will be based on the conditions. You need to watch, you need to look at the question and relate it to these conditions to ensure that they are in the same direction. So you need to notice as well. It is only expenditure incurred after the completion criteria have been met, which should be recognized as an asset. After the criteria, that is time we're going to capitalize the development expenditure. Development expenditure recognized as an expense in the profit or loss cannot subsequently be reinstated as an asset. For instance, prior, let's say in 2024, we have been involved directly in the development of this particular project, right? Now, but when you look at the condition, we did not meet these conditions, so we are going to expense it, though it is a development cost. So now in 2025, these conditions are met, so automatically the cost that has already been expensed in the financial statement for 2024 cannot be reinstated in 2025. So this is what exactly the concept is trying to say. The development expenditure recognized as an expense in the profit or loss cannot subsequently be reinstated as an asset. We need to notice as well. Now, if an item of plant, very important point, if an item of plant is used in the development process, the depreciation on the plant is added to the development cost in intangible assets during the period that the project meets their development criteria. So now if we are going to use a plant in the development phase, the depreciation during the period, once the conditions are met, after that period, we are going to calculate depreciation on the plant and machinery, for example. And the depreciation cost, we are going to include it as part of the development cost of the intangible assets. We need to notice down. That is because the economy benefit gained from the plant in this period is only realized when the development project is complete and production is on the way. So now we need to note this as well. Development expenditure should be amortized over its useful life as soon as commercial production begins. So now this is all what we need to know about IAS 38, the intangible assets. We need to know the distinction between the research and development costs. We need to know the criteria for development cost, whether or not we are going to capitalize the development cost. And for development costs that has already been expensed in the financial statement, we are not going to reinstate that development cost back to the financial statement. So these are the concepts we need to know. So now let's take a look at examples so we can able to grasp the concept well. I am not going to solve any question because when we are going to do our live online session, we are going to solve all of the examples and also we are going to look at cheat questions. So now, example one, an entity has incurred the following expenditure during the current year. A brand name relating to a specific range of chocolate bars purchased for $200,000 by the year end, and by the year end, a brand specialist had valued this at $250,000. So it is clear, according to IAS 38, purchased intangible assets should be recognized in the financial statements. Clear. But now we have an exception that brand names, patents, we are not going to, it is prohibited according to IAS 38 to revalue brand name. So we are going to recognize the intangible assets with a value of $200,000, not $250. So this is the reason why you need to understand the concept. Because for objective test questions, these are the areas that the examiner will use to trap some of the students. Second point, $500,000 spent on developing a new line of confectionery, including $150,000 spent on researching the product before management gave approval to fully fund the project. So 150 is a research cost, so we are going to expense it direct. Then the 350, we are going to capitalize it as development cost because management gave approval to fully fund the project. It means all of the conditions are met. The resources is available, management commitment to fund the project, the cost can be measured reliable, the $250,000, and management commitment indicated that they have been doing board meeting, they have minutes of the various meeting, and also they have approval. So we need to create the linkages between the real life application and the concept. Finally, training cost for staff to use a new manufacturing process. The total training cost amounts to $100,000 and staff are expected to remain for an average of 5 years. Requirements explain the accounting treatment. We're going to look at it when we're going to